welcome to the show. Mphasis has reported its fourth quarterly results, and we have with us the top management of Mphasis, Nitin Rakesh, as well as Manish Tukkar joining us to add more color to how the performance was in this particular quarter and also the way forward, especially also Blackstone-backed growth that they are going to see going forward after the transaction at the parent level. Thank you so much, gentlemen, for joining us right here on Moneycontrol. Nitin, starting with you, give us the highlights of this particular quarter. What really transpired? You have a constant currency growth for the year at 4.9%. Street was expecting slightly above 5%, but your run rate in terms of the new deal wins has been good, and you've also given an outlook on Q1 deal win as well. So tell us about the constant currency growth and what really propelled it in the quarter.
Thanks, Nisha, for having us. I think, in continuation with the performance we've shown in the last two quarters, I think we bottomed out in June quarter last year with the whole COVID impact. And I think recovered really quickly, and we had a record, quarter-over-quarter growth in September. We had a pretty good showing in December again. So in continuation of that, I think we've seen a pretty good growth powered by our direct business. Direct business grew over 3.5% sequentially. Full company, of course, grew 2% sequentially. And I think the highlight of the quarter continues to be the strong deal wins at $245 million for the quarter, net new TCV. Of course, we also announced a new deal of $250 million that was signed after the close of the quarter, which obviously gives a very good, strong track record, visibility into FY22. And of course, the fact that at a very steady clip, we are not only bringing in, big new TCV wins, but also larger deals. I think this is the first year on record where we've signed, 100 million plus, 200 million plus, and a 250 million plus deal, all within the same financial year. So as a result, 51% year-over-year jump in net new TCV for the direct business, a record of all sorts. I think we've sold more business this year in direct in TCV terms than we actually recorded in revenue in the direct business. So that's actually very unique, in our business. So I think that's truly the highlight of the quarter and the year. Of course, the direct business revenue growth has been very strong as well, at 17% for the full year in constant currency. By far the industry-leading growth. Of course, the full company growth came at about 5.5% in dollar terms. Obviously the impact of some of that was the decline in the DXC business as forecasted and guided. So I think we're very pleased with the overall performance, both on the revenue terms and growth terms, TCV terms, and of course, margins have been fairly stable as well. Again, within the guided band of, around 16%.
Right. And what is the guidance for next year, Nitin, in this particular financial year? You've already stated that Q1 deal win has been at $250 million. So how sustainable is the deal win? Because last year has been a record year for you in terms of direct wins. And is that going to be sustainable? And what is the guidance of growth for the current financial year?
So Nisha, I think the $250 million that we announced in Q1 was actually one deal. Right? So we only announced one large deal in the Q1 timeframe. Of course, there will be more deals to go with that. So clearly, our deal win number for Q1 will be very healthy as well, purely based on the fact that just one deal was $250 million that we just announced. I think the guidance for us, from our standpoint on revenue for direct businesses, we probably have market-leading revenue growth in the direct business, which in this quarter is 86% of revenue, which clearly has been the growth driver. Europe has actually been a really strong growth driver. It's grown 25% year over year, and we expect that growth to continue. Given that the Q4 large deal, there was one large deal in Q4 that came from continental Europe. And then we obviously have this Q1 deal that we announced also came from Europe. So I think Europe growth will continue to be very strong. We'll continue to guide towards the fact that direct business will grow market leading. And of course, we expect our overall company growth as well to be in the top quartile.
And in terms of guidance, are you ready to give a number this year?
We normally don't give number guidance. I think we continue to guide relative growth numbers, which is what I just said, that I think direct business will be at market leading growth, and overall company definitely top quartile. On the margin front, we are expanding the upper end of the guidance range from 15.5 to 16.5 as in FY21 to 15.5 to 17 by FY22. We've kept a little bit of flexibility given the uncertainty going on right now, with the situation, especially in India. As that improves over the next couple of quarters, we'll be able to tighten this band. But there's definitely an upward bias to margin, aided, of course, by the fact that we have a strong revenue tailwind.
Right. When you say industry growth guidance, Nitin, I'll pick your brain a little more to get some understanding. Companies like Mphasis and other leaders, as well as even Forge, which became a big news point, they have highlighted a very strong growth in this year. Is it going to be, outperforming those kind of levels that have already been spelled out by some of your peers? Or are you looking at inline? So give us a sense in terms of high teens. Yes.
Yeah. For the direct business, I think we are probably going to surpass all the current guidance given by all the other peers. For the overall company growth, we'll have to see where we end up with the rest of the business portfolio. But definitely, if 86% of the revenue, we are talking about growing at, industry leading number, which is higher than the rest of the guidance, that definitely puts us in the top quartile range.
Right. Manish, welcome to the discussion. I want to understand the breakup of the constant currency growth. What propelled what, and how is the breakup stacking up?
When you say breakup, I'm assuming you mean by the vertical. So obviously, banking capital markets was our biggest vertical and the highest growth driver. And I think the very interesting thing, unlike most of our peer group, is that the largest of our clients actually drove the growth as well. So if you look at the top 5 and the 6 to 10 clients in the company, they were actually growing at faster than the company average. So at an overall level, given our customer centricity and given the investments that we made, our philosophy for the year, as you know, was to stay in a narrow margin range while investing for growth. That clearly seems to be paying off, given how the client metric has moved, given how we have been able to grow our large customers and still maintain margins within that narrow band. So on an overall basis, whether you look at from a vertical perspective, we actually got 2 new verticals, or high tech actually became a large vertical. We saw insurance coming back on track, quarter-on-quarter sequential growth for 2 quarters. So on an overall basis, vertical-wise, geography-wise, top customers and top 10 customers, on all metrics, I would say they all drove the constant currency growth.
Right. On the net profit front, Manish, help us understand, it declined by 2.6% on a QOQ basis, and you also have a one-time income tax benefit of 424 million. Give us a sense on what led to the net profit decline. Is it recurring? And also the income tax aspect, and is that also going to be recurring in nature?
So let me take the second one first. Last year, Q4, if you remember, we had announced that there was a one-time benefit that we got in income tax, which led to a significant jump in net profits and the EPS for the quarter. And hence, when we do a comparison on a like-to-like basis, on a quarter-on-quarter basis, as in Q4 of this year versus Q4 of last year, we actually have a growth of 2% approximately in EPS. Coming to your first question on Q3 versus Q4, we had a 16.4% operating profit in Q3, and that was aided by multiple factors. One, while we had some challenge because of furlough, but we had a lot of upsides coming in because of some contracts which were coming to completion. And as you know, in the mortgage business, when you are starting a new project, for the first 60 months till the files get completed, the revenues don't come in while you have people already on the floor. So that caused some of those costs to be there without the revenues. So there was a compounding effect. 16.4% margin of Q3 actually came down to 16.1%. And despite the revenue growth that we got at an overall company level of 2 percentage points, it ended up being a reduction in operating profits. But that's neither of those are reflective of run rate, I would say. From a run rate perspective, actually we saw an improvement in both profitability and profits on a quarter-on-quarter basis.
Right.
I think just the right way to think about it is that the decline that you're seeing really is the transition stroke ramp up costs that we took in Q4, which will actually lead to revenue growth in Q1 and Q2. So it's really all about transition and ramp up costs, which is actually the best way to spend your investment money.
Right. And also within, DXC business, that revenue decline has been a concern on your books. And of course, you have direct businesses, new deal wins really kicking in for the current financial year as well. And that is likely to offset. Give me in absolute numbers, the kind of business you would have lost due to decline in DXC business, and the offsetting that you have done by new deal wins. I want to know how it stacks up in terms of offsetting the DXC impact.
So I think, Nisha, the best way to think about it is that the DXC business was 24% of revenues at the end of FY20. I think we're right now tracking at on a Q4 run rate basis about 12% of revenue. So clearly, it has gone from being about 75 million a quarter to about 40 million a quarter this quarter. And none of that is really a surprise. Of course, we had guided that we are investing for growth in the direct business. We saw a great opportunity with the tailwinds that we saw early part of FY21 to continue to do what we think is the right thing to do in the long term, which is to actually really accelerate the growth in direct at the cost of everything else. Because to us, that is quote unquote higher priority, higher value business. Not that we don't value every other customer, but just given the nature of the client relationships that we run on the direct side, it just seemed to make sense for us to continue to reduce our reliance and diversify away from one large client risk. So I think from a concentration standpoint, this is probably the healthiest way to build the business around it. And that's exactly what we've done. And I think that's the plan. And we expect the contribution from that channel continue to actually decline through FY22 as well.
Yes, it will continue to decline. And my only understanding that I required in the street will also be looking out for in terms of stock performance is the guidance that you give in terms of if $250 million is the run rate for your new deal wins, suppose for this particular financial year. What is the rate of decline that we are seeing in DXC business? And is the rate of decline higher than the deal wins, or it's the other way around? That's the sense which will give some more clarity.
Nisha, it can't be higher than the deal wins, right? Otherwise, we would have overall company revenue decline. You're clearly seen that even with the 30 to 40% decline that we talked about on that channel, our overall company growth we haven't actually dipped on a quarterly basis with YOY. We haven't gone below positive growth in YOY basis in any of the 4 quarters despite COVID. I think the guidance that I'm giving you for FY22 on revenue, which is top quartile revenue growth and direct business to be market leading growth, should give you a sense that we definitely have tailwinds and deal momentum that will help us overcome any declines that we expect in the DXC business.
Right. So deal wins, the kind that you saw in the last year is sustainable in this particular year as well.
We've already given you guidance for Q1 with one deal itself being 250. And I think the pipeline has actually never been better. Despite record conversion, we're also adding the deals in the pipeline at a record pace. So I think it's a very, very encouraging sign that we're not only able to close deals, we're actually even able to originate new deals at the same clip.
All right. So Manish, going forward now, tell us the geographical breakup for this quarter and how it stacked up. Nitin already mentioned about the European business doing well. But as we see recovery over across the globe from COVID, how is the discretionary spend in various geographies really reflecting now? And where do you see maximum growth at this point?
So while we have the second wave of pandemic impact the supply so far as India is concerned, I guess from a demand perspective, things are looking as good as they have been. Like Nitin mentioned, we had a $1 billion conversion, and on top of that, our pipeline looks bigger than it has ever been. So yes. That's also reflective of our confidence in what we think would be the TCV wins go forward basis. And given already one deals are in the execution phase, that should give us a tailwind on the revenue also. So on an overall basis, I would say, given our investments in being proactive in trying to work with primarily transformation projects with the customers, helping them in coming out of this crisis in the first place, we actually see ourselves to be on the winning side of the customer because we are the ones who are helping them to be prepared for the new normal, so to speak. Yeah. And hence, I don't know whether we would call it discretionary, but clearly we seem to be, the ones who are benefiting from the reallocation of budgets that the customer are doing. So, yes. And that has been the trend of the last 4 quarters. And we think we are in the same position given our conversations with the customers where they want to do more and more of the transformation stuff with us. So on an overall basis, I would say the demand environment looks good, at least from our vantage point.
Right. What about pricing power, Manish? Now, see, onshoring, offshoring, the dynamics have changed permanently for some time. And that is also giving you the cost benefit. What is the kind of benefit you're deriving out of it? And have your customers now started asking also for a discount in the pricing because of the onshoring cost, efficiency?
That's a good question, Nisha. And I guess, if you look back over the last few quarters, what we have been saying is that while the traditional model was on-site pricing, offshore pricing, because most times you are providing people and you are looking at rate per person per hour.
Yes.
Given the kind of work that we do, which is mostly transformation, where we are using deal archetypes like zero cost transformation, it's more about the value we deliver to the customer rather than the price that we charge, which is why for us on-site offshore makes rate per person on-site offshore actually is not that significant. If you also look at some of the peer group comparisons, the new age companies, the EPAMs and the Globants of the world, they are also moving in the same direction. So,
yes.
So when we do a deal, we actually look at the profitability of the deal at an EBIT level. And to deliver the best outcome for the customer, whatever is the mix required, on-site and offshore, whatever is the mix required of tech versus ops, as long as that delivers the right outcome for the customer, right from the front to the back, I think we are able to keep for ourselves what gives us the confidence on margin being in that narrow range, despite the investments. And that's what, if you see, is reflected in this quarter's performance as well. I talked about earlier the geography makes the top client metrics, but if you see, our offshore concentration has gone up, offshore revenue contribution has gone up, and similarly, as the projects now come to maturity, our ops revenues have also come to stability, while tech has actually taken a higher growth. So on an overall basis, it's, given the 60-70% of the business coming from new gen transformative kind of business, and focus being on EBIT at the deal level, we don't see us getting into conversations with the client where they are saying, tell me, how can you give me 5% discount on this FTE or 5% discount on the offshore rates? It's actually always about, if you deliver the value, you keep what you think is the right number for yourself.
All right. So you've already given the guidance on the margin front. Yes.
I just want to add one more thing on the pricing side. I think we've also talked about in the past that 80+% of our deals are generated proactively out of the TCV that we declare. What that means is that we are typically not reactive. We're not waiting for an RFP and then bidding the RFP. And that's typically when you see, a lot of price destruction. What we're typically doing is engaging early, using our tribes, architecture, design, and engineering groups in actually engaging with the client really early on when they're thinking through the right design, the right architecture, the right problem statement. And what that does is it gives us kind of an inside track to get a much better sense of what the client priorities are and how we can construct the deal in a way that it doesn't become about price alone. So I think from that standpoint, that very high proactive percentage, early engagement with tribes and tech advisory group is really a true differentiator. And at that point, pricing is while it's always important, it's not the only factor that clients look at. So I think from our standpoint,
of course, Nitin, you've already shown your mettle in also keeping your legacy BFSI customers as well. So that says a lot, and I'll take your outlook on that. But Manish, first of all, you announced the dividend and special dividend as well. So post the dividend payout to the shareholders, what will be the cash position left with Mphasis?
Well, as of the year end, we had $407 million, and we are now consistently for the last 4 quarters, we generated more than $40 million a quarter. So given the dividend payout may take some bit of time, we will accumulate more cash. And if you look at the last maybe 12 quarters, and if you look at the last 3-4 years, this is probably towards the higher end of the cash balance that the company ever had.
Yes.
Last year, we took a conscious call that given the pandemic and given our desire to do inorganic transactions, we should keep ourselves, with some cash. And despite the dividend payout, I think we will have sufficient cash, and we did that exercise to
Can
make
you
sure
give me
that
a number, Manish?
A number for what, Nisha? Number for
like how much cash post dividend would be? I mean, it's not very difficult to calculate.
Yeah. Means $167 million will be the dividend payout at 65 rupees, and 407 is what we currently have. So we are talking about 230 million. And then, if you add 45 million approximately addition every quarter, you can do the math
Yes.
in terms of what the cash
Yes,
is.
it will keep on generating and adding up every quarter. Yes. So Nitin, cash management, and now that the deal overhang is gone, Blackstone's new fund has taken over the controlling stake from the older fund, which was your parent company. Give us a sense now. First, tell me about your cash utilization. Is a buyback in the offing? And on the other hand, what is your stance on acquisitions now that you are firmly backed by Blackstone for many more years to come?
So Nisha, firstly, I think that the transaction is not yet completed. It's only announced. I think it will take 3-4 months from a regulatory standpoint to actually get closed. So we are in that in-between phase where we are still owned by the original parent company, but a deal is.
But the clarity has come, Nitin. So I am asking you about backed by that.
So I just want to clarify that the transaction is not over yet. We are in that transition phase, awaiting regulatory approval.
Yes.
Assuming the transaction gets over, of course, there is continuity from a stakeholder standpoint. But keep in mind, we have 3 new stakeholders between GIC, ADIA, and UC regions. I think the sense is pretty clear. There will be potentially additional growth levers that we will deploy using strategic M&A. I think we've so far done tuck-in capability acquisitions. We're getting a little bit more, assertive around finding, growth drivers. So there's definitely some thinking around that, and which is the reason why, Manish talked about the fact that, we'll have about 250 million plus whatever quarterly cash generation we do still available to us. And of course, this is pure cash on the book. So that should still give us some gunpowder dry to look at an acquisition that will actually meaningfully move, from a growth standpoint, and also help us diversify, the declines that we've seen in one client. Secondly, I think your question around buyback, I think the fact that we announced a 100% payout, which is typically, 40%, 60% of, kind of was the average practice. So we've already given out a special dividend in addition to the regular annual dividend. At this point in time, I don't think there is a thinking at the board level to consider a buyback. But of course, that may change as we go through the next, few meetings. But at this point in time, you can consider the special dividend to be in lieu of any other cash return, program.
Right. So yes, special dividend already there, and buyback you are saying not on the annual, Nitin.
Yeah, purely based on the fact that we considered how much cash was appropriate to return, and we follow that to the dividend. Yes.
All right. You said diversification and acquisition will be led by that. What is it that you want to add to your portfolio? What is it that you'll be hunting for?
I think there are some interesting, verticals that we still don't have a very big play in. I mean, there are some interesting work being done in areas around, we've done a good job of building high tech to a almost $100 million vertical now, but we could always add with new clients and new age clients. We've done great work with the continent, with Europe and UK, but it's mostly been UK driven. So I think there's always opportunity for us to add new geographic sleeves to our growth. And of course, anything that brings us a combination of competency plus vertical plus geography is kind of the trifecta that will be perfect.
Right. So Nitin, I wanted to understand now Blackstone's business continuity. How will it impact the company? Because I did also hear during the deal, talks going on, that Blackstone adds a large part of your, deal wins as well. It has connected you to their global portfolio companies as well, which you have benefited from. How will that growth continuity go? And if you can give us some numbers on Blackstone-led deal wins and that timeline as well.
So I think Manish gave you an idea of where the growth drivers are on the engines of growth. Top 5 accounts, top 10 accounts, top 20 accounts are all drivers of growth. There are Blackstone portfolio companies in the top 20, so definitely they're included in some of that growth. But I think the growth is very broad-based and very diversified between geography, vertical, and of course, existing versus new clients as well. So I wouldn't say that they give us a large part of the growth, but they've definitely helped us with new business. Yes. We expect that to continue to be the case. I think the overall company has to grow across multiple vectors. It's not just a one-trick pony. So we never were reliant only on one channel or one source of growth. So from that standpoint, we expect that we'll continue to see good deal wins from Blackstone. We have about 12 to 13 clients from that channel. there's no reason we shouldn't be adding, as many in the next 3 years again as we have done. And I think I've said that before, that we do expect that we can get to double digits in revenue contribution. We're not there yet. We are still in, in
mid-single digit. And
so we're not there yet, but we can definitely get there. But keep in mind, the rest of the company is growing as well. Right? So for it to stay in mid-single digits, it still has to grow at company level. For it to get to double digits, it has to grow faster than company.
No,
so I think
I'm
that's
talking
the endeavor,
only
right?
about added benefit, Nitin. It's just to top up.
I think continuity is always good. Visibility is always good. Sponsorship is always good, and of course, people who've made the investment have also clearly seen the benefit from having synergy in the portfolio. So we have a very strong support top down at Blackstone. Of course, the more we can do, the more we'll take. But at this point in time, continuity is actually the best news for us.
Right. So you said double digit we'll reach sometime. Can that be expected this financial year?
No, I would say over the next 3 years. Because keep in mind, the rest of the business is growing as well.
Yes. So the pie also increases. So therefore the share.
Correct.
I get that. But your new investors who have come in, you see GIC and Adia. So how does that impact? Would you be benefiting from any of their clientele as well?
Yes, absolutely. We've actually already expanded our PE channel to start working with them and exploring opportunities. It'll take us a couple of quarters to settle down and find the right targets because, as you can imagine, they have a very widespread range of investments across the world. So we have to find the right intersection points between, our strategy, our offerings, their investments. And of course, at the right time, they'll continue to open doors for us. So we definitely believe that we have tremendous opportunity. Just keep in mind, that as the transaction closes over the next quarter or two, we'll get a lot more clarity, and that gives us a little bit of runway to also prepare and plan.
Right. So, Manish, give us a sense on the timeline for the open offer. I know it's a parent-led and a sponsor-led process, but what's the timeline for open offer that we're looking at? And the management can also give some clarity on, if the open offer is not successful, is the parent company okay with that? Because it doesn't look like that market will see traction at a much lower level at which the stock has risen also, and with the growth potential that is seen. So is there an inbuilt clause of some bit of a stake which needs to be tendered in the open offer? If you can give some clarity?
So I can talk about what's the publicly available information, and as we speak, the approval requests for competition commission, etc., are being worked upon. Once those approvals are in place, which typically takes 1.5 to 2 months time, one needs to then apply to stock exchange and SEBI for an approval for the open offer. And once that is achieved, then you make an open offer, which needs to be kept open for about 10 days. Once all of that is done, then you come to the board and you get the board approval for the reconstitution of the board. And that's when the conclusion of the transaction happens. So we are hoping that, we should be able to get all of these done in the next maybe 4 to 5 months. And if things go well, then we should have the board meeting conclusion happening in our, or rather the AGM discussion happening in sometime around September.
All right. So that process will take some time. But Nitin, what is the reasoning behind 7% being held by the previous fund?
I don't think it's a given, Nisha. 7% will be held only if the open offer is fully subscribed. Otherwise, it will not be held. So it's a simple mathematics that a promoter cannot hold more than 75%. And hence, as they classify a new promoter, then declassify the old holder as a promoter. The old holder becomes an investor. But if the open offer is not subscribed fully, then you won't see the 7% necessarily. And if the open offer is not subscribed at all, then the entire holding will move anyways.
All right. Okay. Thanks for giving that clarity. That was very important. And Manish, what about attrition as well as hiring for this fiscal?
So clearly, the kind of work that we do and, the new gen and the transformation kind of work requires you to be working with people who are typically classified as hot skills. The good news is that we are not entirely dependent on hiring from the market. We have a very robust talent next platform, wherein we actually invest in continuous training and continuous certification. So in some ways, while we are working with hot skills, I would say our relative attrition for those skills compared to market would be significantly lower. Obviously, what was the attrition when we had the pandemic hit us last year versus what it is now, there has been a bit of a change. There is more demand. There is a higher level of excitement amongst companies to recruit people, and there are some cases where crazy kind of actions are being taken just to fulfill demand. However, in our case, we think we are quite good. We have been able to fulfill our supply. You would have seen about 1,700 people getting added in the company in the last quarter itself. We have record open positions, and we are continuously seeing our ability to fulfill those requirements. So yes, the demand environment is stronger. Supply is constrained. There is a higher degree of demand pushing salary levels up. Competition has also communicated salary hikes, which we did on a regular basis, quarter on quarter, without making any announcements. So on an overall basis, attrition looks to be a little bit higher, but manageable.
Right. And finally, Nitin, I want to understand what are the growth drivers for this financial year? In short, you have mentioned in your statement that go-to-market delivery skills to be accelerated. What do you mean by that? And I want to also understand the COVID-related issues that you are facing and give us a forward-looking view in how your company will shape with the current challenges. What do you foresee?
So I think firstly on the growth drivers, I think it'll be a lot of continuity, but some acceleration. And that's why, we're calling the theme as continuity and acceleration for FY22. We will continue to see, I would say, industry-leading growth in the direct business, led by the applications business, as well as some of the large deals that we've signed on transformation side that bundle many capabilities together. The investment we talked about is actually across 3 or 4 different fronts. Firstly, we've expanded our leadership group because we want to create more leadership bandwidth. So we've added 3 new leaders to our executive committee in the last quarter. Secondly, we've also added new leadership in new regions where we are expanding. We've talked about expansion in the UK. In fact, there was an announcement by the UK PM's office announcing the Mphasis expansion into the UK market, both from a standpoint of local delivery center, as well as some of the other market entry strategies that were supported well by local clients. We also hired some leadership in Canada. We are going to announce next week a major Canadian expansion plan. Thirdly, I think we've also expanded from a delivery standpoint in other markets. So we've expanded our presence in Taiwan. We've added new centers in Mexico and Costa Rica in the last 2 quarters. We've also expanded our center in Estonia and Eastern Europe. So I think idea is to diversify our talent pool and create a true global delivery capability that our clients can access. That's important as well because there are certain skills that are extremely valuable in certain other markets besides the India talent pool. Thirdly, I think we've also talked about investing in expanding our investment in the whole cloud go-to-market piece. We operate, as you know, the tribes and squad model. So cloud is a guild that cuts across multiple different tribes. We are at this point, we've identified, around 6 to 8 core partnerships. We've talked about them in the past, all the way from the hyperscalers. We are already a top partner with AWS and Azure, as well as with VMware. All 3 are driving really solid growth for us. We've also seen good traction with Google, as well as with the Snowflake and ServiceNow. So I think those are some of the strategic partnerships. We're adding more sales bandwidth, we're adding more solutions bandwidth, and more GTM muscle, so we can sell with and sell through with them jointly. We announced a partnership with AWS on the airlines platform about 4 months ago, and that's also starting to yield some good results for us as well. So I think that's a massive investment that we continue to make because almost 40% of our, actually 60% of our wins had a cloud element. And just the cloud portion of our pipeline is up 40% year over year. So I think it's definitely a growth driver. And we're making a ton of in that area.
All right. Thanks so much, Nitin, as well as Manish, for joining us. And do take care of yourself. And all the best for this financial year. Thank you so much.